Imagine handing your state government $5,000 every single year for the next 20 years just for the privilege of collecting the pension you already earned. That is $100,000 gone. Not invested for your grandchildren, not spent on the retirement you spent 40 years planning, not donated to a cause you care about. Just gone. And yet, retirees in 3 specific states are doing exactly that right now. And most of them have no idea because nobody has sat them down and walked through the numbers line by line. Today, I am going to show you the 3 worst states for retirement income taxes in 2026. What they are quietly pulling out of your pension, your Social Security, your 401k, and your traditional IRA. And what the alternatives actually look like when you run the math instead of chasing a headline. This video is for educational purposes only and should not be treated as tax or financial advice. Before you make any decisions based on what you hear here, sit down with a qualified tax professional who can look at the specifics of your situation. My name is Dre. On this channel, every single week, I break down the financial traps, the overlooked tax rules, and the wealth strategies that nobody else seems willing to explain in plain language. If that is the kind of information you want showing up in your feed, tap the subscribe button and turn on notifications so the next video lands in front of you the moment it goes live. Before I name the 3 states, I need to set one thing straight. A lot of retirees hear the phrase no income tax and assume the conversation is over. It is not. States still need revenue, and the ones without an income tax always collect it somewhere else. Sales taxes, property taxes, insurance premiums driven by hurricane or wildfire exposure, HOA fees that creep higher every year. So when I rank these states, I am not staring only at the income tax line. I am looking at how your pension gets treated, how Social Security is taxed, how 401k and IRA distributions are handled, what the estate and inheritance rules look like, and what hidden costs are baked into simply owning a home there. The states I am about to name are the ones where, even after all of that is weighed, retirees are still losing thousands of dollars every year compared to a better structured state. Let me start with number 3. Number 3 on the worst list is Vermont. And before anyone rushes to the comments to defend it, I want to acknowledge something. Vermont is a genuinely beautiful state. The autumn foliage is some of the best scenery in the country. The small towns feel authentic in a way that is increasingly rare. There is a real quality of life case for living there, but none of that changes what the state does to your retirement income. Vermont begins taxing Social Security benefits once your income crosses $50,000 as a single filer. That threshold is the lowest in the entire country, which means middle-income retirees get pulled into the tax earlier than almost anywhere else. Your pension income is taxed at rates that climb as high as 8.75%. Your 401k distributions are treated the same way. Your traditional IRA withdrawals, same story. And once you pass away, Vermont is waiting with a flat 16% estate tax ready to take another slice before anything reaches your heirs. Let me put real numbers on this. A retiree pulling $50,000 from a pension and collecting $25,000 in Social Security is handing Vermont somewhere between $3,000 and $4,000 every single year in state income tax on retirement income alone. That is in a state where property taxes are already among the highest in the Northeast and where the cost of heating oil through a long winter takes another visible chunk out of the monthly budget. Over a 20-year retirement, that is $60,000 to $80,000 paid to the state on money you already earned, already saved, and already paid federal tax on. Number 2 on the worst list is Minnesota. I can already hear the pushback. Minnesota has the Mayo Clinic. Minnesota has elite hospitals. Minnesota has some of the most respected medical infrastructure in the country. All of that is true. And all of that is irrelevant to your monthly budget when the state is reaching into your retirement check at a top rate of 9.85%. That rate applies to your pension income, your 401k withdrawals, and your traditional IRA distributions once you reach the upper brackets. Minnesota also still taxes Social Security for retirees with combined income above roughly $84,000, which sweeps in more middle-class households than most people assume. On top of all of that, the state maintains an estate tax that starts pulling money at the $3 million mark, which sounds like a ceiling that only hits the wealthy until you add together a paid-off home, retirement accounts, and life insurance proceeds. Here's the dollar impact. A retiree collecting a pension of $65,000 and Social Security of $25,000 is paying roughly $4,500 a year to Minnesota in state income tax. That works out to $375, leaving your retirement check every single month for the rest of your life. You can make an honest case that elite healthcare is worth paying a premium for. What you cannot make a case for is paying that premium without ever seeing the line item broken out clearly. When Minnesota retirees actually run this math, a noticeable percentage of them start looking at neighboring states where the winters are comparable, the hospitals are still strong, and the state is not taking nearly as much off the top. And now the one most people already suspect, but very few can actually quote the numbers on. Number one on the worst list is California, the state with the highest marginal income tax rate in the country at 13.3% in the top bracket. To give credit where it is due, California does something generous at the outset. Social Security benefits are fully exempt from state tax. That is real, and it matters. But every other dollar of retirement income you have is fair game. Your pension is taxed. Your 401k withdrawals are taxed. Your traditional IRA distributions are taxed. Annuity income is taxed. There is no special retiree exclusion, no age-based deduction, no carve-out for people living on a fixed income. The same brackets that apply to working Californians in their peak earning years apply to retirees in their 70s and 80s. Here's how it lands in practice. A retiree with $60,000 of pension income and $30,000 coming out of an IRA is handing California roughly $5,400 every year in state income tax. And that is before you factor in a median home price still hovering near $900,000 and homeowners insurance premiums that have roughly doubled in parts of the state over the last 5 years as wildfire risk has been priced into every policy. $5,400 a year does not sound catastrophic on a single line. Multiply it across 20 years of retirement and the number becomes $108,000. That is a 6-figure transfer of wealth paid to the state on income you already earned, already saved, and already paid federal tax on. $108,000 is a down payment on a second home. It is 4 years of college tuition for a grandchild. It is a full decade of travel. And in California, it quietly leaves your account in small increments that are easy to miss until you add them up. The instinct at this point is to pack up and move to a state with no income tax: Florida, Texas, Nevada, Tennessee. The logic feels airtight at first glance, but some of the retirees who make that move based on the income tax headline alone actually spend more, not less, after they arrive. Homeowners insurance in Florida now averages over $7,000 a year and can run over $10,000 in coastal counties. Sales tax in Tennessee tops out near 9.6% and applies to groceries, which eats into savings quietly every single week. Property tax in parts of Texas can exceed 2% of assessed value, which on a $400,000 home is $8,000 a year. Revenue gets collected somewhere. The only real question is whether the somewhere else hits you harder than the income tax did. There are three developments in 2026 that change how this ranking should feel personally relevant. The first is the new senior bonus deduction, created under the One Big Beautiful Bill. If you are 65 or older with modified adjusted gross income below 75,000 single or 150,000 joint, you qualify for an additional $6,000 federal deduction on top of everything else. Married couples where both spouses qualify can stack to $12,000. This is brand new, did not exist before 2025, and a lot of automated tax software has been slow to flag it aggressively. The second is that the SALT deduction cap has lifted from $10,000 to just over $40,000. For retirees in high property tax states who gave up on itemizing back in 2017, the math has quietly flipped. If you have not looked at itemized versus standard deduction since then, this is the year to run the comparison again, because the answer may no longer be what it was. The third is market-driven. With retirement accounts taking volatility hits in recent market swings, a Roth conversion in a depressed market is more attractive than it has been in years. You pay tax on a lower dollar amount today, and every dollar of future growth comes out tax-free. The state you live in when you convert matters enormously. In California, a $50,000 Roth conversion triggers roughly $6,600 in additional state tax. In a state that fully exempts traditional IRA distributions, that same conversion costs zero at the state level. Geography alone can decide whether a conversion is a smart move or a very expensive one. So here is the honest takeaway. Vermont, Minnesota, and California are the three states where retirement income is taking the biggest hit in 2026. If you live in one of them, the answer is not automatic. You weigh what the state gives you, healthcare, lifestyle, proximity to family, the place you have built a life in, against the thousands of dollars leaving your retirement check every single year. Sometimes the right call is to stay and optimize around the tax code with every tool available to you. Sometimes the right call is to look honestly at a state where your pension, your Social Security, and your retirement account distributions get far better treatment. Whatever you choose, make the choice with the actual numbers in front of you rather than a bumper sticker. If this video helped you see those numbers more clearly, hit subscribe, turn on notifications, and I will keep breaking down the rules that actually decide how much of your retirement you get to keep. I will see you in the next one.